Good morning. Thank you for joining us. We have with us this morning Bill Hubbard. He is Chief Economist at Markets.com, over 30 years of trading experience, lecturer at the London School of Economics. Bill, thank you very much for joining us.
Thank you very much for inviting me.
Okay, let's see. Shock and awe. Bank of Japan. Everybody's talking about it. Nobody can get enough of it. I've seen some analysis from Markets.com. Says that if you, with a shift of 5% in from Japanese pension companies, you could see $100 billion of U.S. Treasury purchases.
Very much, very easily, okay? I think one of the things that we're seeing is, from a bond standpoint, unless you're owner of JGBs, this is a bonanza. I mean, we saw last week, we have record yields in Germany, record low yields in the Netherlands, and this is only going to continue because what you're going to see is a major shift, okay, from, say, the carry trade with Japanese yen, now purchases of global bond markets.
Is there something in it for the Eurozone periphery debt? Might it be a small positive?
Well, I think it will be a small positive because the simple fact is, if you reach a point where German yields get too low or French yields get too low, and we had a very positive Italian bond auction today, even after Monti yesterday said that we'll probably have issuance by the Republic of Italy at the all-time high. So yes, it will flow down. Now, I'm not sure, and I'm not going to make any comment, well, it flows down to Cyprus or Greece, etc. But if nothing else, it will at least start to show a decline in some of those exorbitant yields.
Usually I'm not too pessimistic on China, but you hear talk of the shadow banking system, excess bank lending, of problems in some of the provincial governments. Should we keep a certain cautiousness about China, or am I wrong?
Well, I would say you're wrong. I mean, I think one of the points that we have to look at, whether we like it or not, we have seen a massive change in the idea, the concept of China in the past 15 years. And one of the things, remember, China owns 1.6 trillion U.S. Treasury bonds, okay? So the simple fact is they own the market. You saw what it did to the iron ore market. You saw what it did to the Australian dollar, the Australian stock exchange. So I think one of the things that you're starting to see, and I would expect China, not real soon, but sooner rather than later, to start to get involved with the Asian swaps market. Okay, so you'll see the interchange there. I don't see the CNY, the renminbi, becoming a tradable currency because all you got to do is, 10 years ago when the previous government started, they said, we are one government, but with two currencies, meaning renminbi and the Hong Kong dollar.
At the meeting last week, the ECB keeps rates steady. What's going through his head?
Well, don't ask me. I mean, I can tell you what I think should go through his head, but that's, again, I started the year feeling we'd get one, possibly two rate cuts. And I think one of the things that we have to look at is from 1st of February, we had the euro at 137 plus, okay? Prior to the March meeting, we dropped 10 big figures, where if you looking at the swap adjusted spread basis, okay, for the December contract, that had already implied 40 basis points reduction in the refi rate. So maybe they were looking at that. But as you see, in the last 48 hours, you have both Asmussen and also Novotny basically saying, well, we've sort of changed our philosophy in the last 2 months. We think there could be a slowdown. I don't know whether there's a dramatic slowdown or just a slowdown in the Eurozone, and basically inferring that probably a rate cut in May or June. I still think we'll probably see one rate cut, at least one rate cut. Again, I have no idea what month we're looking at, but the Eurozone, what we all looking at is you're starting to see a slight slowdown in Germany. And, I don't know about our good friends, the Parlez-Vous, just across the, the water over there, but I mean, this is Hollande and company. I mean, France is having some very, very difficult times. Years ago, I used to trade BTPs and Italian bond swaps. And I mean, it's sort of like, I've been trading U.S. Treasuries for 40 years, and everybody was saying, well, the Treasury market's going to collapse. The best thing that happened to the Treasury market was when the U.S. lost their AAA rating, okay? And the simple fact is, but you've got to remember, Italy has the third largest bond issuance in the world. So after the U.S., okay, after Germany, you've got banks that own Italian bonds. And one of the things you mentioned about indices, but the indices have got clobbered 6-7 months ago, okay? You had, especially in France and especially in Germany, these were those banks that were dragging the index down because they had to mark to market, okay? As soon as we saw a massive increase in price all of a sudden, some of those banks have been the leaders now in some of those indices. And that's what people really have to look at, okay? Because remember, when when bank lending is a little sluggish, traditionally they buy government bonds.
We talk about the euro, but in the end, what everybody cares about here in the UK is sterling. You have Morgan Stanley say 2 years out, the euro can go down to parity. What about sterling against the dollar, against the euro?
My feeling is with sterling, I'm still negative on sterling. I think we've had a reaction. I think we've had a safe haven buying about the 153.50, 153.70 level. I still feel we'll get 25 to 50 billion in quantitative easing. I don't think we'll get it now till Mark Chili Con Carne takes over on the 1st of July. I mean, when I first Bloomberg in '99 and 2000, we used to trade WTI or against Brent crude. In those days, the simple fact is if WTI was anywhere from $3.50 to $5 higher, you bought Brent crude and you shipped it to the States. That worked very well until probably the Baltic freight futures said, wait a minute, we're not charging them enough. So it's gone from $3.50 to $5, where, a year or so ago, I mean, the premium Brent to WTI was $25. But then again, if you want to look at it from a U.S. standpoint, whether we're talking about fracking, this, that, or the other. I mean, this is, we're talking about a major move here right now, okay? And all you got to do is go to a state called North Dakota. You could have bought the whole state for pocket change, right? I think now they're producing like 5 to 7 millionaires. And this is old Farmer Joan who sold his cow pasture, right? And now they're doing both diesel, natural gas, diesel, and petroleum. So we're seeing, a sizable shift in oil.
Stephen Roach,
okay.
Very well-known economist, very prestigious, ex-chief economist at Morgan Stanley for many years. He's not at all positive on the possible eventual success of quantitative easing in the United States. In fact, he's quite pessimistic. Do you agree? How does that square with all the optimism in the markets?
Well, I basically think that maybe he should have listened to Christine Lagarde yesterday when she said she was quite pleased with the, let's see, I don't speak parlez-vous, but I mean, basically she was saying with the transparency and the forthright market movements, and she basically mentioned both the Federal Reserve and the Bank of England, okay? So that is quantitative easing. So, I mean, I have to feel that it is working, okay? Because the simple fact is it's got people buying, okay? Not so much the peep man on the street, but central banks, okay? So it's helped the U.S. start to recover. It's also helping here in the U.K., okay? The ECB, of course, can't do it because of the limitations of the Maastricht Treaty.
Going back to a theme you were talking about before, about U.S. becoming the next Saudi Arabia. You also talked about recently about an improvement in medium-term expectations, about a U.S. renaissance in manufacturing, jobs coming back to the United States. If you have that, if you have energy independence in the long term, yes, you can still be perhaps pessimistic, but in the end, eventually the U.S. will come out of this and will come out of this quite well. I would think under such a scenario, U.S. banks would do very well.
Yeah, they will, okay? I mean, one of the things that we're seeing, whether it's Basel III or this, that, or the other, you're seeing a reorganization of the banks, and good banks and bad banks, and getting back to traditional banking. Well, they have no choice but to get back to traditional banking. But the simple fact is we're still not seeing lending, okay? And one of the things I think you have to look at is this funding for lending scheme here in the UK. And also what Osborne said in the budget. Not to be negative, but most of the people that they would be lending to are the same people that U.S. banks lent to in 2005, 2006, and 2007. Basically the ones that couldn't afford it, because the simple fact is here you're talking about, well, I'm 35 years old and I've got a child, and so I don't have 60% down payment. So, so then are you setting up a future problem here? And my feeling is that what you are is you're seeing a reorganization, okay? It will be positive for the banks, and I mean, if I were following stocks, I'm bullish on Citigroup, I'm bullish on Bank of America, I'm bullish on Wells Fargo, especially the last two, because they have a huge mortgage portfolio, okay? And this will all start to come back. Also, the simple fact is What about the state of Florida? What about the state of Texas? And as I just mentioned about North Dakota, I mean, all of a sudden, people are buying things in North Dakota which they never bought before. So yes, it will be positive for U.S. banks.
State finances in the U.S. are doing better? There was a moment when you had states like California going through.
Well, maybe if we don't mention like the city of Stockton, California, something like that. Yeah, I mean, it's a real problem. What you'll start seeing there is that as long as you still have municipal bonds, and as long as you know that interest rates are not going to go up, which they're not, okay, then it's just, people will start reinvesting back in it. And it's like anywhere else, whether it be Stockton, California, whether it be Phoenix, Arizona, whether it be Las Vegas. I mean, we're talking about, house prices were going up 80, 90% a year. Before things started collapsing a few years ago. So it will all come back. Also, I still have to feel that the general, positive attitude of Americans, will. I don't think they want to be number two.
Unfortunately, quite unfortunately, we have to wrap it up for today. But Bill Hubbard, Chief Economist at Markets.com, thank you very much.
Thank you for inviting me, and I hope we can do it again.
I certainly hope so.
Brilliant.
And that's all from us here at Digital Look TV for today. But again, thank you very much for joining us, and we look forward to having you with us again next week.